Chapter 3, Learning Objective 4, Depositing FIT and FICA. So once these amounts are withheld, then that whatever's withheld gets matched with what the employer is going to be contributing, and those have to be deposited. So FIT stands for federal income tax. So the FICA is the Social Security and Medicare, and the federal income tax is what is withheld from the employee and forwarded to the Treasury. It does not come out of the employer's pocket, so to speak. So each November, the IRS notifies the employment or the employer whether they're going to be a monthly or a semi-weekly depositor for the next calendar year. And the look-back period is basically that previous year. And depending on the amounts, the bigger the amount, the sooner the IRS wants it. If you're owing them a whole bunch, they don't want you to hold on to it. They want you to send it into them. So that's what determines. If you are a monthly depositor, then you have to pay your FICA and your federal income tax by the 15th of the following month. So if anything that you pay in December, you would owe the following January, the 15th of the month. If you're a semi-weekly payer, and the payday is on a Wednesday, Thursday, or a Friday, then the taxes have to be deposited the following Wednesday. And if the payday is on a Saturday, Sunday, Monday, or Tuesday, then it's due the following Friday. So Tuesday, if it's a payday on a Tuesday, then you've got Wednesday, Thursday, and then Friday is when they're due. There is one exception. There's a one-day rule that says if there's $100,000 or more of federal payroll tax liability that's due, then the taxpayer has until close of the next banking day. So that's the one-day rule. And when we say federal tax liability, if the sum of the FICA and the federal income tax that have been withheld is greater than $100,000, then you've got to pay that by the next banking day. New employers are considered monthly depositors unless they meet this one-day rule. If they've got over $100,000 of liability, then that means they're going to be semi-weekly. And they put new employers as monthly depositors, and then after a year, they might cut them back or change them depending on what their deposits were. So my brother-in-law just went out on his own. He's a patent attorney, and he's been with a big firm. And at the beginning of the year, he went out on his own. And so this is his first year, and so he's automatically a monthly depositor. And after this year, for 2014, they'll look back at 2013, and they'll see what his liabilities were, and maybe he'll be a quarterly depositor. It just depends on how much his tax liabilities are. So just to be clear, I don't want to confuse you. All of the numbers and everything that I'm using here are based on the law in 2012, but I'm actually recording this in 2013. There are different requirements for agricultural and household employees that your book goes into a little bit more. I'm not going to go into them here. The amount deposited might be affected by the safe harbor rule, which basically says if you pay 98% of what you owe, well, I guess another way to say it is if you don't deposit enough, but the deposit is under either $100 or 2% of what you owed, then you can make up the shortfall before the make-up date, and you're not going to be penalized. There's a credit against the required 941 deposits based on COBRA. You might have heard of COBRA, but you probably didn't know it stood for Consolidated Omnibus Budget Reconciliation Act. Side note, one thing I've read about is a lot of the people, Congress people that are bringing up bills, they'll try and give a title to a bill that has a catchy acronym. So whoever came up with this, they probably wanted a catchy acronym like COBRA, and so they had to put in words like omnibus, which is so funny. Anyway, basically what this is it gives employees that are involuntarily terminated, meaning they get fired, between September 1st of '08 and 3/31 of 2010, the option to continue coverage under the company's group health insurance. And actually, it probably still would be going if it wasn't for Obamacare. That changed everything. And they can continue this coverage up to 15 months. Because what happens is, if you get fired, a lot of times you've got pre-existing conditions and you can't get health insurance. So this is designed to give you health insurance in between your jobs. Hopefully the next job you get will cover you again. And so there is a credit of 65% of the premium cost. So the company is reimbursed. They have to pay it, but then they have to pay the insurance, but then they get reimbursed 65% by taking a deduction on this Form 941. And you'll see that when you go to fill out a 941, you'll see a line for this. The employee pays 35% of the premium, and the employer pays 65%. So deposits used to be made. I remember when I first was doing payroll for my dad when I was like 15. This is a long time ago. I would have to fill out a little slip and take it over to the bank. Now they've got ways to do this all electronically, of course. And I don't even think you can do it by the paper-based system anymore. It has to be electronic. Unless you're a super small business. If you owe less than $2,500 in a quarter, then you can do the paper system. And you can enroll online, and all new employers are automatically pre-enrolled. And really, even if you're a small business, it's so much easier to go ahead and do it online. And chances are your payroll's online, so might as well just do this online. There's two methods for paying. There's the direct method, which you withdraw the funds from the employer's bank account and route it to the Treasury, meaning it's the IRS, or rather the Treasury, withdraws them from the bank account and routes it to the Treasury, or the employer instructs their bank to send the payment to the Treasury. So one is a pull transaction, one is a push transaction.